What's up, traders, and welcome back to Explain the Charts. Today is October 7th, 2025, and we're breaking down one of the most watched instruments in the world, the EURUSD. The pair has seen a dramatic reversal from its yearly highs, and a flurry of news suggests the selling pressure is only intensifying. In this video, we will first cover the fundamental news driving this price action, including political turmoil in Europe and Federal Reserve commentary. Then, we'll dive deep into the daily, hourly, and 15-minute charts to pinpoint the key levels you absolutely need to be watching. Before we dig into the charts, it's crucial to understand the macroeconomic storm that's brewing. Right now, the story is all about US dollar strength. A significant driver is political instability in France, with the recent resignation of a prime minister stirring uncertainty and weighing heavily on the euro. Simultaneously, in the United States, stalled government shutdown negotiations are prompting a flight to safety. Historically, during times of global uncertainty, investors flock to the US dollar as a safe haven asset, which puts downward pressure on pairs like EURUSD. Adding fuel to the fire are hawkish remarks from Federal Reserve officials. While the Fed is divided on the path of interest rates, the overarching tone has been one of caution, which markets are interpreting as supportive for the dollar. Analysts are now pointing to the 1.1650 level as a major battleground, a price point we see echoed across multiple financial news outlets. In fact, some reports today claim the price has already broken below 1.17 and is currently trading near 1.1658. However, it's worth noting a counterpoint from Bank of America, which suggests that quantitative signals for the dollar are weakening, so the coming days could be a real test for the bears. This fundamental backdrop of euro weakness and dollar strength provides the perfect context for the bearish price action we're about to analyze. Now, let's turn our attention to the daily chart, which tells a very clear story. For most of 2025, from the lows around 1.03 in March, the bulls were firmly in control, carving out a powerful and sustained uptrend. The price methodically climbed for over 6 months, breaking through previous resistance levels, which may now act as future support. This bullish momentum culminated on September 17th with a peak at a high of 1.1918. This level marked the 2025 high for the pair and, more importantly, it was the catalyst for a massive trend reversal. Since that peak, the sellers have taken complete control. We see a series of large, bearish red candles that have erased months of gains in just a few weeks. This price action is a textbook example of a bearish trend, a consistent pattern of lower highs and lower lows. The price has now fallen into a critical area of prior market structure. If we look back to the period between June and late July, the zone between 1.1500 and 1.1600 was an area of significant consolidation and support. We are now directly testing the upper boundary of that zone, making the current price level incredibly important for the medium-term outlook. For any potential bounce, the first line of resistance would be the recently broken support around 1.1750, a level that bulls failed to reclaim just last week. Let's zoom in on this daily chart to get a closer look at the reversal since the beginning of September. Here you can see the final, exhaustive push-up to the 1.1918 high, followed by an immediate and aggressive rejection candle the very next day. That was the first major warning sign that the bullish momentum was fading. Following that peak, we saw an incredibly sharp decline at the end of September, with the price plummeting through the 1.1800 level with almost no hesitation. The early days of October brought a brief pause, where bulls attempted to stage a recovery. However, that bounce was weak and found a ceiling right around the 1.1740 to 1.1750 area, which was a previous support level that has now clearly flipped into resistance. This failure to reclaim a key level was a strong confirmation of bearish control. The daily candle for October 6th closed around 1.17, but this was a precarious position. As we know from the news, today's session on October 7th saw a decisive break lower, confirming the bearish momentum and putting the critical 1.1650 support level directly in the crosshairs. Now, let's switch to the 1-hour chart to analyze the short-term structure. This time frame gives us a much clearer view of the stair-step pattern of this downtrend. We can observe sharp, impulsive sell-offs, which represent the dominant bearish momentum. These are followed by shallow, corrective pullbacks or sideways consolidations, where the price seems to just pause before the next leg down. This type of price action is very characteristic of a strong, healthy downtrend. If we look at the most recent data we have on this chart from October 6th, we can see the price was trapped in a tight range, mostly below the 1.1720 mark. Every attempt by buyers to push higher was quickly met with significant selling pressure, creating a series of lower highs even on this short time frame. This tight consolidation right under a key psychological level, like 1.17, often precedes a major breakout. In this case, it was building up energy for the bearish continuation that news outlets are reporting today. The inability to mount any meaningful bounce was a clear signal that sellers were simply reloading for the next push lower. Finally, drilling down to the 15-minute chart from October 6th reveals the intraday battle in granular detail. Throughout the European and US sessions, we can see multiple attempts to rally that were sharply rejected from the 1.1725 to 1.1730 resistance zone. Each of these failures to push higher emboldened sellers and discouraged buyers. The price action was sluggish and lacked any real conviction from the bull camp. This persistent failure to break even minor intraday resistance levels was a significant clue that the underlying weakness was profound. This setup, where buyers repeatedly show their weakness at a specific level, is often the final piece of evidence traders look for before a breakdown. It signaled that the path of least resistance was clearly to the downside, setting the stage for the drop below 1.17 that followed. So, to bring it all together, let's pull back to the daily chart for a final summary and outlook. The key price levels you must have on your chart are as follows. For support, the immediate and most critical level is 1.1656, a level cited by analysts and confirmed by chart structure. If that level breaks and we get a daily close below it, the next logical targets are 1.1620 and then the psychological support at 1.1590. Below that, we're looking at the broader 1.1500 support zone from the summer. To the upside, resistance is now layered. The 1.1700 to 1.1710 area is the first minor hurdle. However, the more significant resistance zone is between 1.1745 and 1.1780, where the last rally failed. Only a decisive break above 1.1800 would begin to challenge the current bearish market structure. The bearish case is currently the high-probability scenario, perhaps with a 75% likelihood. The trend is bearish on all major time frames, and the fundamental news is a strong headwind for the euro. A confirmed daily close below 1.1650 would reinforce this outlook and likely accelerate the selling. For the bullish case to have any merit, which is a lower probability at around 25%, we would need to see a very strong defense of this 1.1650 area. Look for signs of seller exhaustion, like a long wicked hammer or a strong bullish engulfing candle on the daily chart at this support. This would indicate a potential short-term bottom is forming, but bulls face a very difficult climb. Looking ahead, the main event to watch for will be the upcoming FOMC minutes, which could provide more clarity on the Federal Reserve's policy direction and cause significant volatility. Also, continue to monitor headlines out of Europe, as any further signs of political instability will almost certainly weigh on the euro. That's our comprehensive breakdown of EURUSD for today. If you found this analysis insightful, please hit that like button, subscribe to Explain the Charts, and click the notification bell so you never miss an update. Please remember, this content is for educational purposes only and should not be considered financial advice. Always conduct your own thorough research and practice proper risk management before making any trading or investment decisions. Trade safe, and we'll see you in the next video.